Thank you very much. Thanks for your work today on ZMC, and thank you to the other panelists and speakers, and thank you for coming today. Yes, the topic today is going to be on global equities, and I think the racing theme is very exciting this year. Markets have been racing ahead for 2 years. We've had a great, fantastic run as global economy has been doing better than expected. And what happens as the race goes on for 2 years is you want to check your engine, you want to check your tires, you want to see that the thing is still working properly. You want to make sure that your portfolio is suitable for the weather that might be coming in. And so what we'll talk about today is we'll talk a little bit about what markets have done and what our outlook for markets are for the year to come. We've heard a little bit, and you'll hear a couple of consistent themes as we go through. So let's see if this clicker works to move ahead. We can get the clicker adjusted if that's okay, or move to the next slide. Fantastic. So looking back at 2024, if I was to move overhead one more, 2024 was a year where we saw fantastic equity gains. 2023 was another year with fantastic equity gains. If we can move to the next slide while we're getting the clicker fixed, please. Fantastic. All right. So looking back at the last 2 years, we've seen 2 great years of equity markets run. US really stood out in terms of performance for the last 2 years. US tech was an even better performer, and we've seen some of that in the polls that you've taken during the last fireside chat. But beyond that, global equities itself returned almost 20% for 2 years running. Malaysia equities caught up a little bit last year with a 20% US dollar return. But across the board, we've seen good markets. If we were to look back at what the market was thinking at the beginning of 2024, right, that might be an indication for as we're thinking at 2025 going ahead, what kinds of things did we miss when we were looking back? So let's go back to 2024 at the beginning of the year. In 2023 and early 2024, growth expectations for the US were about 0.8%. As the year went on, the US really took pole position in that race, strengthening the economy. The resilience that we were seeing and the growth that the US was delivering really surprised markets on the upside. And you saw US ended the year with 2.7% GDP growth, while Euro and Japan struggled a little bit more, fairly in line with consensus with Europe and maybe a little bit of hardship in Japan, given the rate hiking cycle that we started to see. But that was a big miss for markets, underestimating US growth. Well, what else did markets miss? Well, if we look at emerging markets, as the US growth really saw resilience and that exceptionalism that we heard an earlier panelist talk about, emerging markets also started to do better. If you look in Asia, key economies, as you're looking at the revisions to forecast, China, Korea, India, and even Latin America, growth expectations increased throughout the year, and the delivery of stronger growth was a theme that we saw in 2024. Resilience across some of these emerging markets on the back of US exceptionalism. Well, there was a third miss that we saw at the beginning of last year, where markets were expecting the Fed to cut 4 times and equity markets to perhaps have a little bit of volatility. US markets and the growth in the size of US markets, I think, has been a little bit underestimated. How big can the US market grow? The US equity market right now is about 9 times as large as all emerging markets put together. 9 times as large as all emerging markets put together in terms of the size of the equity market. And if you look at when the last time that was, it was in the early 2000s as the China market was starting to see more IPOs come to market and the growth of the China and the Asia story. But US exceptionalism is not just a GDP story. It's an equity story as well. And it's really been driving and supporting US markets or global markets through 2024. So where are we now? Well, let's take a check on the speedometer. Let's take a look at the global macro conditions, all right? As we take a look at the race conditions and where we are, we also have to pay attention to the rain clouds or the storm clouds that might be gathering on the horizon. And we'll talk a little bit about what those look like, because the change in weather could change how you want to adapt your portfolio. So, Global economic growth. I've talked about US exceptionalism in 2024. What are we going to see in 2025? Well, as we enter 2025, what we've seen is the economic data through the second half of the year of 2024 has been surprising on the upside. And the economic data specifically for the US has been surprising on the upside. And when you get upside surprises, you get happy investors. On the downside, you're seeing Europe struggle a little bit more. And so there's a little bit of divergence here with US exceptionalism and perhaps European underperformance from an economic perspective. But what you have supporting markets at the moment is a consistent growth or support from global central banks. What you see on the right-hand chart here is as the numbers spike up, that's the number of central banks globally that are cutting rates, easing their policy. And if you see how high what we've seen in the last few months is relative to the last 30 years of history, we've never seen this many cuts at the same time outside of a period of crisis. COVID, the GFC, we've seen more cuts consecutively by global central banks now than we saw in the Asian financial crisis or the dot-com bubble. And we're not in a recession, mostly globally. We're not in a crisis period. And so this support by global central banks is going to be a continued theme in 2025. Let's go back to the U.S. economy and the exceptionalism that we're talking about. U.S. consumers are feeling very wealthy at the moment. They're seeing their household wealth having risen for the last year to a very high level in terms of how much wealth they feel relative to their disposable income. And that is positive for growth. That is positive for consumer spending. It's similar for corporates. Corporate balance sheets are quite clean at the moment for U.S. companies. Large cap corporates managed to borrow a lot of money before rates were rising, and therefore they're actually in very stable positions. Earnings growth next year is looking pretty healthy. And so corporates and households in the U.S. are looking pretty good. What about the labor market? What we have here on the right-hand side is the labor market numbers in the U.S., a few different metrics measuring labor market numbers. And the job market is still strong. Unemployment is low. You've seen a little bit of a downturn from the peak periods right here in terms of job openings and the number of hirings and how quickly it takes for someone who quits their job to find a new job. What we saw 2 years ago with employees quitting in the US and finding a new job within a day or two, now it takes maybe a couple of weeks, a few months. Still a strong market, but you're seeing a few cracks start to come in. One of those clouds gathering on the horizon that might change the weather as we're racing ahead. So the Fed thinks about job market. They also think about inflation. What you can see with inflation at the moment is we've seen this downward trend. Disinflation is continuing. Breaking down the data a little bit more, if you're looking at what is actually still driving inflation, the key numbers that we're seeing at the moment largely come from shelter, that's rents. Well, rents have 12, 24-month cycles, and so that takes longer to feed through in the data. Our expectation is that inflation will continue to go down. However, the Fed has just indicated that they might not cut as much next year. They want to watch the data before they cut more. And why is that? Well, I think one of their main concerns is they don't want a repeat of what happened in the 70s. What we have here in the dark blue line is as you saw inflation spike in the early 70s, the Fed hiked rates significantly and we saw inflation come down. And as that inflation was coming down, the Fed cut aggressively in order to support growth. And what they saw in 1977, 1978 was a spike in inflation again. And that was pretty bad for the US economy in the 70s and early 80s. And so what do we see with the light blue line? Well, we've seen a pretty consistent trend for the last few years. And we're at this inflection point right now where the danger of a resurgence in inflation, I think, is key in mind for global central banks and for the US in particular. And so the idea of taking it a little bit slower is something that the US Fed is really considering, making sure the data is consistent with an easing inflation, with a slowing economy, still strong, but looking at growth prospects this year for maybe 2%. And so what are they looking to do? Well, markets last year were projecting about 4 cuts in 2025. After December, when the Fed decided to say maybe 2 cuts was more realistic, markets are now projecting 1 to 1.5 cuts. We still think that the Fed has more room to ease than the 1.5 cuts, but perhaps a little bit later in the year. Our expectation and support for global equity markets and others is that the Fed will cut 2 to 3 times, perhaps towards the second half of the year, and that easing policy will come through. But it is lower than what we're seeing in other global markets. I talked about European markets struggling a little bit. The EU and the European Central Bank and the Bank of England are likely to cut 4, 5, 6 times next year to support a slowing economy that we're seeing over in Europe. So you're seeing a divergence between Europe and the US. And this is all important because these are some of the drivers and support for some of the equity markets that we're seeing. Support for some of the economies that are struggling a little bit more in Europe relative to the US. You're seeing similar levels of cuts on the India Bank of Reserve, as well as in China, we're expecting to see some cuts too. And the importance of this divergence will also have ramifications in terms of currency. We've seen US dollar as a very strong currency for the last few years. It has been an exceptional strength, gone through a period of exceptional strength relative to global currencies. And with the Fed cutting less than other global central banks, we're expecting this US dollar exceptionalism to continue. US dollar strength is another theme that we're seeing in 2025. And so what does this mean? Well, we've got an idea of the weather conditions right now as we're looking and entering 2025. We're expecting central banks to support growth, US economic exceptionalism, perhaps a little bit less of an exceptionalism in Europe. But as you look on the horizons, you need to make sure that the gathering clouds and the weather that you're seeing will influence how you're adjusting your portfolio. Are those weather patterns and the storm clouds are gathering? Are they going to rain on the parade and slow down the racetrack, the racing speed? Or are they going to pass by so you can continue to race ahead in dry weather? Well, let's take a look at some of the uncertainties, some of what those storm clouds look like. We heard one of the last panelists talk about equity valuations being expensive in the US. This is true. On the right-hand side of each of these boxes, you see the percentage of time that a market has been cheaper than it is right now. The more red, the more expensive. The more green, the cheaper the market is relative to history. And this is using underlying data, price to earnings, price to book, a little bit of dividend yield. And what you can see is global equity markets have been cheaper 94% of the time. US equity markets have been cheaper 99% of the time, particularly in the US large cap space. So equity markets are looking expensive in the global markets as well as in the US market. But valuations do not tell you very much about short-term performance. Long-term, sure, 10 years, 20 years. Short-term performance, valuations matter little. Cheap stocks can remain cheap. Expensive stocks can remain expensive. And what's important is looking under the hood. If I'd shown you these charts last year at the end of 2023, beginning of 2024, you know what you would have seen? You also would have seen about 97, 98%. And so on a short-term basis, fundamentals really are what drive markets. And what do the fundamentals look like? Well, US equities are showing, and US stocks are showing healthy expectations for returns. That strong US economy and that US economic exceptionalism we've been talking about have been fairly stable and will drive earnings and sales returns for US companies. You're seeing about an average 15% growth expectation for earnings next year. And that translates into investor returns. And so the expectations of strong earnings should continue to propel favorable sentiment for US equities. Global earnings projections, about 12% on average, expectations for next year. And so we're positive on global equities with some caution. Quick touch on fixed income. I think one of our last panelists also said you have to pay attention a little bit to fixed income even when you're talking about equities. And so I'll highlight a little bit what we see in fixed income. As we've looked historically with high levels of income that we're seeing in the markets that we at the moment, you look at as the Fed starts to cut their rate hike cycle, what does that mean? Well, if you combine all of the periods previously, as the central banks, the Fed specifically, starts to cut rates, during periods where there's a recession or a growth scare or just a normalization like the period we're in now, the returns that you would expect or that you've seen historically for fixed income markets have actually been relatively healthy. And so we don't dislike fixed income, but we do see risk on as our key call for our investment outlook. I think there's one more point I'll highlight, and this is a little bit of a supporting technical factor. There is almost $7 trillion. Let me repeat that because it's with a T. $7 trillion US dollars sitting in money market funds in the US, outside of deposits. And as the Fed starts to cut rates, the return that these investors are getting is going to be a little bit less attractive. We see this as a possible technical support for markets. Cash that's sitting in money markets can be used to buy into fixed income or into equities. And with that $7 trillion sitting on the sideline waiting for an entry point, we see that as a technical support for risk assets. And so as we look at the gathering storms on the horizon, wondering whether they will come and hit, I've touched upon a little of them, but they are a few. Geopolitics, open conflicts in the US and Europe and the Middle East. The central banks having a delicate balance about easing to support growth, but be wary of inflation returning. High valuations we talked about. And yet we see signs of positivity. US economic policy, the new Trump administration with their ideas of deregulation and supporting growth. These are all positive for risk assets as we begin 2025. Will there be volatility? Well, no one can guarantee that a 2 a.m. tweet won't necessarily disrupt markets in the first couple of months, as we see a little bit of volatility that's been talked about by some of the earlier panelists. But we do see that underlying support for global equities is fairly positive. And it's important to note, I think there's this last point at the bottom right here. Global equity market rallies usually are killed not by sentiment, but by recessions. And with expectations of global growth driven and supported by US growth, we don't foresee a recession for 2025. And so, as we check our tires, what are we looking at? Well, we are positive on equities. I think that's fairly obvious from the way I've been talking. We're about neutral on fixed income, and we're underweight on alternatives. Our view in equities, no surprise, we are positive on US equities. The strength of the economy, the strength of companies and corporates, and the strength of the consumer all are favorable tailwinds for the US economy and US economic equity market. We're also favorable. We like Japan. We like developed market Asia, some developed markets in Asia, in particular Taiwan as part of that technology bubble. We saw a couple of stocks return very healthy earnings returns this last week. We're about neutral on the rest of emerging markets with a big underweight to Europe. And it's important to remember, an underweight to Europe doesn't mean that all European companies are bad, right? European companies, by and large, take 50% of their revenue from outside of Europe. And so it's important to make sure you're picking the right companies, you're picking fund managers who know how to pick the right companies when you're investing into European markets, because there still continue to be some opportunities there. And so what does this mean? What do we like? Well, I'm here to introduce the Principal Global Titans Fund. This is a fund that accesses growth opportunities around global markets with a focus on developed markets, US, Europe, and Japan. You can see from our outlook, we're overweight US, we're underweight Europe, and we're overweight Japan. But the way that we do this, and I'll take a little bit about what the portfolio manager at Fund Supermart was saying, is we access these markets through both active fund managers as well as passive indexes and ETFs. Highly liquid, beta exposure to markets, and the capacity to be able to move in and out quickly in order to be dynamic and tactical in our trading. The fund itself is rated 4 stars by Morningstar. It's got a Lipper score of 5 on total return and consistent return. And in ringgit terms, you've got about 15% return on the last 3-year basis, which is still a fairly healthy return for a fund of this type. Catching up and keeping up with the equity markets there. I've highlighted in terms of the allocations, we're overweight US, we're underweight Europe, and we're overweight Japan. Passive ETFs and active fund managers combined with an active overlay is how this fund is managed to help give you and deliver on growth market opportunities on a risk-on basis if your view is consistent, and something to consider as we enter 2025 with the equity market rally, with the storms gathering on the horizon, but with the weather conditions clear for races to continue and for the races ahead to continue to speed forward. Thank you very much, and I'll end right there.